Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me Michael Oliver. He's usually with us the first segment, but today I decided to have him on at the end of the show, given the content of the first two segments with Daniel and with Richard Mayberry. Michael, thanks for joining me again.
Glad to be back, Jay. I'm clear enough. I'm on my cell phone now.
I understand, but you sound pretty good
okay.
for now. So, OliverMSA.com, folks, OliverMSA.com. You hear it from us every week, and whenever Michael's on, you should hear it from us when he's not on, too, because he does such good work. Michael, in one of your recent weekend missives, you warned the long-dated U.S. bonds, the Japanese bonds, German Bunds, that they're all looking like they're in some big trouble in 2018. You're seeing it that way still, right?
Absolutely. Yeah, no, it's when you look at a price chart of those bonds, German, Japanese, and ours, you don't quite see the vulnerability. But when you look at a momentum chart, an annual momentum chart, going back a decade or so, you really see the structural vulnerability, and the numbers are going to jump in January. As of 2018, the three-year average is going to move up, which puts the annual momentum structures that we see in dire straits. In other words, our current price level is going to be threatened by the rising three-year average, such that the momentum chart is going to likely break down next year, highly likely. In fact, the Bunds are in a default position. In other words, where they are right now is unacceptable when they open January, because if they close out the month of January anywhere around where they are now, they blow out massive support structures. And the JGB is the most egregiously manipulated bond in the world, maybe other than the Italian bonds, are 1 point away, and they're just below 151. They can't close out a month much below 150 next year. They break down. So actually, we expect on a breakdown, meaning a rise in rates, that the Japanese and the Germans will outpace us in terms of the snap effect of a trend change, because we weren't quite so egregiously manipulated as they were. And therefore, when it comes unwound, the one that was the beach ball that was pushed more underwater than it should have been will come rushing more up out of the water more rapidly, if you follow what I'm saying. So, yeah, I think it's an inevitability. I think 2018, you break the bonds. Now, and that's going to have an impact. It may be delayed, but it's going to have an impact on stocks, because we're not looking for a minor move in rates. We're looking for something that's substantial.
All right. What do we need to see now on the S&P, Michael, to cause you concern on the downside?
Well, on the S&P, I'm particularly yesterday. I get very excited. I was looking at the Nasdaq. A lot of because I see Nasdaq's been the leader. Nasdaq 100 in particular, I'm talking about, is full of those FANG stocks, and they're heavily weighted on the front end. And actually the Dow, which is quite interesting, because here you have a blue chip index as opposed to loaded with the FANG stocks, although it does have them in there, has really outpaced the S&P. Look at a Dow industrial stock, just the price chart, going back years, 10 years or so, is far more in an accelerated blow-off mode than the S&P is. It looks more like a Nasdaq 100. And those two are very close to levels, such that if you pick up just a little bit, a couple percent from where you are right now, you're going to unleash them on the downside, I would say to the tune of about 10%, very rapidly. Now, admittedly, you could get that kind of drop. I'm not looking for a crash. I think if you're going to go into a bear market, I think you're going to go into it in layers, with jolts, but not you're not going to drop 25, 30%. I don't foresee that. I see a bear market coming. I see blow-off tops, particularly in the Nasdaq 100 and in the Dow. And when you have blow-off markets, vertical markets that move out above angles of ascent that had previously defined the market's rise. In other words, it might have been a certain degree angle for 5-10 years, and then suddenly you go through the top of that channel and go vertical. That kind of behavior is indicative of the end of a trend. Now, if that behavior occurred early in a bull trend, that's different. But if it occurs 5, 6, 7 years into a bull trend, you get blow-off action. You can count the months. It's going to end. It's the way markets terminate, with unusual excess and eagerness to own it. And when those come unwound, they really come unwound. And that's what it looks like we're doing here, is we've had a blow-off in the Nasdaq 100, FANG stocks, and in the Dow Industrials. and it won't take much to really unwind them.
So you have
go ahead.
So you have a rising interest rate environment here in these sovereign risk bonds. You would think that the governments are going to do what they can to try to.
Well, sure. No.
What can they do?
On the other hand, there's a reality out there, and just like in nature, there's a reality that you can't break its rules forever, where you'll suffer. Well, in markets, there's a reality too, and sometimes it can be delayed by central banks. And right now, it's been distorted and delayed for a decade. We've had QEs out the yin yang, and it's created an unreality and a lot of causal effect relationships that come from that. That businessmen make business decisions, investors make the decisions, households make decisions based on certain factors, such as the level of interest rates. Well, if that's a false reality that you've based all your decisions on, then many of your decisions and the consequences thereof are not going to be what you thought they were, because if those rates shift because they were unreal, then all kinds of things get upset. Plans and so forth, corporate, personal, and government. Now, there's a point at which central banks simply can't fight reality. They've distorted it too much that the snap effect it ambushes them. And I'm not sure they're really ready for it. I'm not at all sure that they're aware of what they're facing at all in terms of the unwinding effect.
Well, they certainly don't want us to think they're unaware or that they're not ready. That's for sure. So maybe a lot of it is just posturing what they're saying. It's a little propaganda, I suppose. But in any event, it certainly would seem to me that in a rising interest rate environment, that couldn't be terribly bullish, or shouldn't be terribly bullish, one would think, for the commodities. Yet you're pretty bullish on the commodities, especially the soft commodities, I believe, heading into 2018, right?
The grains and the meats in particular, which were not players over the last year and a half. All they did is they laid at their lows. They were, in fact, a negative impact on let's say, the Bloomberg or the CRB index. And I think they're about to have an uprising, just like the bonds are going to have a downrising. The structures are equal and opposite the other way on grains, for example, and even cattle. That they're basically, all you have to do is hiccup 1% or 2% higher than you are now in those markets. And I'm going to blow out the top end of basing patterns on annual momentum to go back much as 5 years. So it looks like both a food commodity inflation will come suddenly in a rush and therefore be surprising. And at the same time, what we think is a controlled market, the bond market, is going to begin to become unhinged. And I think the shock effect of that will cause, again, investor asset reallocation. And the investors are big players in this. They've bought into the QE stuff. It worked. It feels good. It still feels good. It feels static right now, particularly U.S. market. And therefore, it's just like the Bitcoin. It's inducing irrational behavior and untested ground and emotions. And when that comes unwound, it's chaotic.
All right, Michael, with 1 minute left.
Yeah.
We've only got about a minute left. We haven't touched on gold yet. It seems like your 1245 line in the sand to go neutral might hold again. What do you think the odds are for it?
I think so. That's the third time since December last year, then in July of this year, and then again recently. I didn't want to see a certain number violated, in this case on a weekly closing basis. I didn't want to see it close under 1245.
Right.
We suggested maybe go to neutral if that happened, or hedge with GLD puts to go out to February. You don't need much time on this because the vulnerability window is short, I think. But they've rallied $20-some, 30 off the recent low. We're at 1262. I think if you close the month out much above about 1263, that's a solid sign that you've seen the low. And there's also a trigger level that isn't just solid sign. It's like breaking through a hurdle up around 1283 on a weekly close. I think you're going to launch back into the 1300s again. So right now we're 1262 basically on the spot contract, and it's looking steady. And the dollar is also getting weak again.
Yeah, I noticed. The dollar's getting weak, and what about silver? We still have another minute left. Could you comment on silver?
It's a sloppy child. I still think silver will outpace gold once you get the thing really moving, once you get the engine rolling in gold. Right now we've warmed it up over the last year and a half is basically what gold's done. I think silver, I can give you a number, it's basically up in the 1860s, which seems a long way, but we've been there a couple times in the last few years. You go there again, you're going to run hard. there's a massive breakout level in annual momentum, a secondary level that if you see about 1865, you should just launch big time. And at that point, I would expect silver to sort of leave gold behind in the dust on a percent basis.
All right. Well, I do want to talk to you about your outlook for 2018. We'll probably do it next week or the following week if you're available. But thank you again, Michael. Always a pleasure to have you with us, and you have such great insights. And my confidence grows every time you name one of these lines in the sand that's not defined, not penetrated. So all I can say is the reason you're on every week is because my confidence continues to grow in your calls. So thank you so much for sharing your time with our listeners.